Good evening, friends, ladies and gentlemen. Today we have a session on AS 11 and AS 18. But before that, let's rise up for the motto of the song.
Yaesha sukteshu jagrati Yaesha sukteshu jagrati Kamam 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 Pursho nirvimana nirvimana Tadeva shukram brahma Tasmin lokah shataha sarve taduna sarve kashjana etat vaita etat vaita etat vaita etat vaita etat vaita etat vaita.
Please be seated. I request our learned speaker Mahesh Nayak and our regional council member Ritesh Moore to please come up on the dais. A big round of applause. Friends, I guess we are going through a turmoil stage. Like every day something new is happening. I think it's a new era of professionals which is getting born up in the last couple of years with the advent of GST, with the advent of Companies Act 2013, Insolvency Act. This is a great move by the Institute of Chartered Accountants of India on coming up with this refresher course on ATS. And the most important topic we are going to discuss today is on intangible assets and borrowing cost by Manas Roy. Dr. Amitabh Mukherjee is going to join us very soon and he's going to discuss on investment property. To brief you about our speaker, Manas Ranjan Nayak, a very eminent speaker, a young guy. He's a senior manager in Deloitte Haskell and Sells. He has over 8 years of experience in audit and assurance service, a chartered accountant which holds a BCom degree, and specialized in Indian GAAP and IFRS and in AS. His focus sector in auditing and other assurance related assignment cater to the manufacturing, telecom and mining. He was a part of audit and assurance team in companies like Tata Steel, Vodafone, Shenik Process, Tata Steel Minerals Canada and various Singapore entities. Having experience in consolidation of accounts and audit under various GAAP. He is actively involved in auditing and implementation of various IND-AS assignments like Tata Steel and its group companies, NIPCO, Orissa Mining Company, etc. So what we can expect today is a lot of case studies, right Manas? A lot of case studies and practical discussion which we can talk to Manas on this whole affair. Big round of applause for Manas. And I request Shiv Kedia to please come forward and offer a flower bouquet just as a token of appreciation to Manas. Thank you so much, and just stay tuned. We'll be having a lot of sessions like this coming up. And over to you, Ritesh. You want to say something? Yeah. So request Manas to start his deliberations. Thank you.
Good evening, and myself already introduced by Sanjeev. So myself Manas, I am currently working with Deloitte in Kolkata, and basically deal in I'm into audit advisory, that is basically deal in Ind-AS implementation and key Ind-AS consultation. So today we are going to discuss two topics which are key topics in Ind AS, that is Ind AS 23, which will deal with borrowing cost, and Ind AS 38, which is intangibles. But for ease, if you look into Ind AS 38, then you have to look into another two Ind ASs also, that is Ind AS 16 and Ind AS 36, which is deals about PPE and impairment. So however, the time is short, so start with borrowing cost. So borrowing cost, if you compare with our previous AS 16, you will find no major differences. No major differences in borrowing cost. However, there are certain key differences which are coming from the implication of other account Ind AS standards. Like borrowing cost definition is earlier there in our AS 16, but borrowing cost definition under Ind AS big difference. What is that difference? So if you go to financial instrument standard, which is 109, there it talks about when you calculate borrowings at amortized cost, that is effective interest rate applicable over there. So the borrowing cost now will directly relate into the effective interest rate method. So whatever borrowing cost earlier what happened when we incur interest, so if only other expenses are not there, so that is classified as borrowing cost, and there is a qualifying asset, so we capitalize that borrowing cost. So today in Ind AS scenario, interest only not the only one component, because interest will be going to be calculated under 109. 109 is dealt about financial instruments, which talks about when you measure a financial liability at amortized cost, then you have to calculate the cost under effective interest rate method. What is this effective interest rate method? Just a glimpse of it. Suppose today I went to a bank and asked for a loan at an interest rate of 10% per annum, but I paid a processing fees of 10 rupees on a 100 rupees loan. So I got 90 rupees and I will pay the interest on the due dates, that is 10% on 100 rupees. So this will be my payment, and the principal payment after 2 years or 3 years, whatever period may be. Under Ind AS, if you want to recognize this particular financial liability under amortized cost, then what you have to do? You have to calculate the effective interest rate calculations, EIR method. What is EIR method again? So you got 90 rupees. On 90 rupees you are paying the interest. So 90 rupees becomes 100 rupees after 2 years. Then interest payments, scheduled interest payments, you have to take account of all this. Your interest rate will come 11% or 12%, bit higher than the interest rate which is there in the loan. So whatever interest will come from this particular calculation will be qualified as borrowing cost. An effective interest rate method will be a lot of challenging, because 109 talks about financial assets and financial liability. Financial liability classifications are, there are earlier the equivalent standard IS 39, which is currently not there in our Ind AS. So that standards requires a lot of classification, but these standards requires only 3 classifications, that is fair value through OCI, fair value through P&L, and amortized cost. So effective interest rate method, when you calculate interest, that particular interest will eligible as borrowing cost, and when you have a qualifying asset, you can capitalize that particular interest. So it's similar to our previous Indian GAAP, that is AS 16, that you have a qualifying asset and you have borrowing cost. So you can capitalize that borrowing cost to the qualifying assets. So what is qualifying assets? Again, that is similar as earlier standards. These standards, there is no difference in qualifying assets. So qualifying assets will be those assets which takes, those assets which take a substantial amount of time to get capitalized, and the borrowing cost we incur in that particular construction period. So it's directly related to that. so we can capitalize that borrowing cost. So it's similar to our previous gap, so we will not face any difficulties. And scope exception, again big difference, scope exception. In our previous gap there is no investment property. We classify all assets, all assets basically into PPE, property, plant, equipment and intangibles. But here if you come to Ind AS, there is a class of assets which called investment of property, where you have invested or constructed a particular building or property which you want to get the rental income from that particular property, which classifies under the definition of Ind AS 41 as investment property. So 40 investment property, then that particular assets you cannot, that scope exception is over here. In biological assets you cannot particularly capitalize this. However, there is a recent amendment to bearer plants. If this particular borrowing cost is relating to a bearer plant, and bearer plant meet the definition of Ind AS 16, that is property, plant, equipment, then you can capitalize interest borrowing cost relating to that particular bearer plant. And that's already I spoke about, that is interest expenses calculated using effective interest rate method as described is under Ind AS 109. So if any doubts or difficulties in understanding effective interest rate method, so I can give another example also.
So you spoke of the financial instrument where effective interest rate is taken. In case of preference share, it is not capital, it is liability. But still effective interest rate is not taken for computing the cost of preference share. Am I wrong?
I have not got your question.
I am saying in case of liability, you are taking effective interest rate.
Yes.
But for how you will be valuing the preference share? Because this is a liability and you are not taking effective interest rate.
No. Preference also taken as interest cost. Again, preference capital is a different financial liability item. It's not equivalent to bond. So preference capital comes with convertible options, redeemable options, and cumulative option, non-cumulative options. So what kind of preference share you are dealing? So if it is having no conversion option, then it is purely a liability. Even though we disclose it as preference shares, it's not shares, it's a financial liability. So if you are measuring a financial liability, then again the classification is there. So in that classification, if preference share measured at that your intention to keep that particular, that you will pay interest and finally the principal outpayment, all those criteria is met, then you classify it as an amortized cost. Then if amortized cost and that preference capital is used in the qualifying assets, in that particular period you are paying dividends on that particular item, it qualifies, then it's a borrowing cost.
And if it is perpetual, then
Which is perpetual?
preference capital.
Perpetual, again there is a different in classification. If it is a perpetually, there is no redemption option, then it will be tested for equity classification. If it will be a equity classification, definitely there will be no borrowing cost involved in that. Any question on effective interest rate method?
This will keep on changing the interest rate, so accordingly, I mean,
If interest rate is fluctuating, then definitely effective interest rate method will not change. Money EIR will get changed.
How do you compute the EIR? This is IRR method, internal rate of return.
You can say so. It's not IRR. You can say so. Another change, it's not a change from this particular, it's not a difference between AS 16 and Ind AS 23, but it's a change from different standards. Earlier in Indian GAAP means our accounting standards, if there is a lease agreement, we account for lease, then we evaluate for operating lease and finance lease. When you come into Ind AS scenario, it's totally different. How it is different? That arrangement containing lease, if you go into Ind AS 17 appendixes, there is appendix C over there in Ind AS 17, which talks about when you conclude particular arrangement as lease. Then lease classification, operating and finance lease. Even an example, in earlier days, if we don't have a lease agreement in particular plant, suppose I am a steel manufacturer, there is a particular power generator inside my factory, and he's built that particular power unit solely for consumption of my unit, but I am paying them a power cost. So all these kinds of agreements, which are long-term agreements, the total in output will be dependent on that particular entity, and there is a fixed pay involved. All those criteria are there. So if those criteria are met and it is a lease, and then we evaluate for operating lease and finance lease. So if it will be a finance lease, earlier you have paid only power expenses, and in your books there is a power expenses sitting in your P&L, because we prepare our financial statements under nature, by nature. So in our P&L it will come as power expenses. But today, after conclude it as a lease and finance lease, that power expenses go bifurcated into two things. One is interest cost, one is lease payments. So again, that particular interest cost is available for capitalization under borrowing cost. So earlier we are not able to bifurcate, we don't know that there is a power expenses, it's a power expenses. He is billing us for supplying 100 units of power, so we are paying for 100 units of power. Whether interest is there or not there, we don't know that. But this is a gap difference. So there is a long-term contract. Another example, power. There are oxygen. It is there in our S19 also. How you bifurcate particular, how the minimum lease payments over the period, how we calculate it, it's the same method, no difference. S19 and in S17, there is no difference in the lease bifurcation or lease classification, all those things. Only extra thing which is there in Index 17 is that some appendices. Basically, these are not appendices, these are under IFRS are IFRICs. So these are now in Index when we adopt Index. So in Index, these are basically given as appendices. So one of those appendices are arrangement containing lease. These arrangements in earlier gap, we never accounted for it. Like I given an example of power, now I given an example of oxygens. A lot of big manufacturing companies having oxygen plants inside their factories. These oxygen plants are not their plants. It's basically the plants of BOC or Praxair, all those entities. These entities basically build this particular oxygen plant for the full supply of that particular unit for consumption of in that steel industry or any power industry. So those plants now come under the purview of lease, and when we account for that particular lease, earlier what? We purchase those and we account for that particular item, purchase of gas. Earlier we account for that particular item as a purchase of gas. Now we have to show it as a interest cost and then lease payments.
So there will be no gas cost.
It's a gas cost, but it's a lease. Asset will come into my books. So I am generating the gas, so whatever cost will be there, it's my cost.
But in the user's PL, there will be interest cost and there will be lease cost. But in operating expenses, there will be no expense for gas or power.
No, because I am producing all those units. No, I am producing and consuming. It's a sub-process expenditure. By nature, it's a lease. The assets will come into my books. I will produce something and consume it in my process. So I consume heat also, I consume lights also, all those things. Those are not appearing in my P&L. Incur by nature. By nature, if I incur any expenditures, those will come in financial
So
statements.
then two companies, one is IFRS compliant, one is not IFRS compliant, the cost will not be compared.
Yes, you can say so. So what happened? So if there is any arrangement which falls under the definition of lease under Index 17 and we calculate interest over there, so that all interest also qualifies as borrowing cost. We can capitalize that particular interest also. So earlier this is not there. Again, this particular item when I am describing, it's having a lot of impact on inventory also. For a manufacturing entity, when they are paying, incurring any expenditure, they inventorize it. When they are producing particular thing, they inventorize it. It's a direct expenditure, consumption of gas, consumption of power, all these are direct expenditure. But now on, after this particular arrangement classified as lease, interest component is there, and our standards does not allow interest to be capitalized in inventories. So our inventory value will reduce. If any such contract which we classify, earlier it is not classified as lease, today under Ind AS we classified as this contract as lease, and interest expenses is there, so our inventory valuation will get reduced by that particular interest, because interest will be not part of inventory cost. And this is similar, this third exchange differences, this is similar, this is ASI 10. Basically, if you remember AS 16, read with ASI 10, it talks about when we borrow in foreign currencies, so our interest rate may be lower in foreign currency. So there you have to look into the exchange rate. So if that particular exchange rate is compensating the interest cost, then that exchange fluctuation can be capitalized as borrowing cost. So it's similar to that of our previous standards, there is no difference. These three things, any questions?
So
These are new.
I think it has not been discussed so far. Foreign currency for IFRS purpose will be which currency? Foreign currency.
Foreign currency is always a foreign currency.
Suppose if it is a conglomerate having global operations.
So that is a functional currency, it's not foreign currency. That's Ind AS 21 talks about functional currency. So functional currency, again, functional currency depends on the risk and then all those things in which currency you are dealing. So classification, it's a different standard
Other
altogether.
than functional currency, all others will be foreign currency.
Yes, well, in the currency I am preparing my financial statements is my reporting currency. And other than that, whatever currency is a foreign currency. So any question on these three particular line? Very interesting. That is, now interest will change. Earlier if we are able to capitalize 10 rupees as interest, now we can capitalize 12 rupees by the impact of effective interest rate method. Then we can capitalize the expenditure which earlier non-classified in our financial statement as interest expenses, but today due to change in accounting we classified those particular items as lease, and there is a interest payment on those lease, so we can classify those. So these are the three major differences. So this I already spoke about. It is ASI 10, Accounting Standard Interpretation 10. I read with 424 I think of AS 16. That is foreign exchange fluctuation you can capitalize as borrowing cost. So this is basically happened in India when we go for borrowing in US dollars and GBPs and or euros, then our interest rate is much lower, whereas the foreign exchange fluctuations are higher. So that we can conclude there is no gap difference in AS 23 and AS 16 does not have any gap difference over here. This is quite similar. Borrowing cost directly attributable to the acquisition, construction and production of qualifying assets can be capitalized. This is similar to in AS 16. There is no difference. If there is a qualifying asset, we have a borrowing cost, then we can capitalize that borrowing cost into that particular cost of the assets. There is no difference in this. So in totality, there is no difference in AS 16 and in AS 23. So it remains, our ITFG also not got any questions on Ind AS 23. ITFG referred to our institutes, this technical group which is giving up their answers to all the problems which we are facing in Ind AS implementation. So our ITFG group also not faced any question on Ind AS 23. So there is no difference altogether. There are little bit differences. So I can answer the questions you have relating to Ind AS 23. If I will take you through the standards, then it is similar to AS 16. You will find nothing relating to this 23. There's a commencement of capitalization, it's same. Once the commencement of the capitalization is done, then borrowing cost will not be capitalized, cessation of borrowing cost, all those things, all the same. There is no difference in this.
Is there anything connected to purchase of an asset by issue of capital? Does the standard cover that?
Purchase of?
Any asset, I mean any borrowing which has to be settled by that could be a convertible.
So major two takeaways from this particular standard is that borrowing cost includes whatever items are there. Two additional item will come. One is interest expenses under the lease arrangements under Ind AS 17. When we conclude a particular arrangement as lease, and earlier those expenses are not in the financial statement in the nature of finance cost. Today it is finance cost, so we can capitalize that item. And second item is that our interest capitalization can increase because we are calculating today interest under effective interest rate method. So these are two major differences. Any questions on this standard?
So long the interest, the fluctuation, foreign currency loss arising on account of the borrowing in foreign currency and the fluctuation, that used to be detailed for, that used to be disclosed as foreign currency loss, foreign exchange fluctuation loss. Now you are saying that it will be disclosed as financial cost.
No, there is no gap difference in this particular item. What I am saying is that when we are borrowing in foreign currency,
Yeah.
and the interest rate is 2%,
Yeah.
if we borrow that particular item in India in INR and the interest rate is 4% or
Yeah.
5%,
Yeah.
so standards AS 16 also, in AS 23 also said that the foreign exchange fluctuation coming by converting that particular loan or interest expenses to Indian currency, whatever foreign exchange fluctuation is there, to the extent the difference between 4% and 2%. Okay, there is a earlier in our Indian GAAP standards AS 16, there is a particular ASI,
Okay.
Accounting Standard Interpretation 10.
Okay.
You can refer that. So there is no difference.
No difference.
So that particular foreign exchange fluctuation you can capitalize as a borrowing cost. It
Either
meets the
capitalized or
definition.
charged to revenue.
Sorry.
Either capitalized or charged to revenue as the case may be.
Yes.
What about the exchange fluctuation on the principal itself?
Principle itself I am talking about.
Okay.
Principle itself is a different standard paragraph altogether. If you remember in 2009, Institute made some amendment, that is FCMITD, if you remember. If you have a foreign currency borrowing loan or long-term loan and you have acquired those loans for purchasing of assets, so any foreign exchange fluctuation on those particular assets, so those you can capitalize. What Ind AS did, this particular provision is not there in our Ind AS 21. But in carve out, they bring out certain carve out. Carve out means this is a basic difference between the Ind AS and IFRS standards. So they bring out this carve out that the loan existed on the transition date. Means transition date means today all listed entities, phase 1 entities are already under Ind AS from 1st April 2016. So on the opening balance sheet date, whatever loans are there, those loans, foreign currency loans, you can capitalize those foreign exchange fluctuation to your block. But going forward, if you acquire any further assets prospectively, you cannot capitalize. That particular carve out is there in Ind AS. So our IGAP and Ind AS bit similar on this particular foreign exchange fluctuation.
In case of suspension of the project, then interest rate, what will be the
Sorry?
Suppose if the project is suspended for the time being. For the suspended period, borrowing cost can be.
See, if you read through the plain reading of the standards, the suspension of then borrowing cost cannot be capitalized. It's a P&L expenses. There is no difference between A16 and Ind AS 23. However, in that particular time, you have to look into that whether it is a controllable suspension or uncontrollable due to various factors. Because whole logic behind capitalizing borrowing cost is that this particular cost I am incurring at the time of when I am installing or in the constructing this particular machinery. So it should be a direct cost. If I am not, when my production or my construction is totally stopped, why should I capitalize? That is the logic of the standard. Because it's not giving any value to the fixed assets. It's not changing the value of the fixed assets. Only I am capitalizing this particular item. So if you read plain, then suspension, yes, no, cannot be capitalized. You need to look other factors, whether those factors asked me to capitalize this particular interest expenses in the suspension period.
Post suspension, if the asset is again borrowing cost is due, then that period again the borrowing cost will capitalize.
Yes, you need to evaluate those criteria. If those criteria is met, you can capitalize those borrowing costs. Any other questions?
Suppose a plant it is ready but cannot be commissioned because a trial run cannot take place. In that case, it will cease to be capitalized.
It's the same as, there is no difference. Same. Earlier, if we are capitalizing that particular item, today also under Ind AS we are eligible to capitalize. Yes, my answer will be no. If everything is ready, if I will capitalize, it's not adding value, any increase in capacity. So it should not be capitalized. But there is no difference in Ind AS and IGAP. AS16, AS23, there is no difference in this particular item. All are same. Only numbers Ind AS 23 and that is AS16. Yes.
All the leases are to be covered.
Sorry?
Lease, you said. What are the criteria to be covered in case of lease to be covered here?
Arrangement containing lease. Arrangement containing lease, you need to look into the entirety of the agreement. Entirety of the agreement means normally the agreement structured in such a manner that I will consume 100% unit of that particular unit, but that asset is constructed by the outside the company, and I will pay him rentals, and there is fixed pay also. So fixed pay also means even though he is not supplying me any units of the productions, I will end up paying the fixed cost. So if you look at all these contracts in our Indian GAAP also, we never looked into in that nature.
That's the clause is the minimum rentals that.
Correct, fixed pay. If there is fixed pay, how these fixed pays are derived? That this fixed pay into number of years of the machinery, if you multiply, then your asset value today will be arrived. That is the minimum lease payment, MLP. So MLP is a familiar term with us because AS19 also the same term, MLP. So MLP into number of useful life, if you multiply and it is coming to your asset value today, so it's an asset in your books. So you have to classify that particular thing as a finance lease and first lease, evaluate for lease. If it is a lease, then you evaluate all those criteria. There is no difference. That is the total useful life. I am using the significant useful life.
There should be any criteria that the plant will be transferred to.
If yes, that is one of the criteria in the classification, no? Operating lease and finance
Suppose
lease.
that clause is not there, that plant will be transferred back.
That's okay, even though that clause is not there, first you need to conclude these arrangements whether it's a lease or not. After you conclude it is a lease, then your path is smooth because AS19 and Ind AS 17 there is no difference in the classification. To whatever criteria we read in a previous gap, those are there. Whether the asset will be transferred at a nominal value, whether I am using the significant useful life, all those things you have to evaluate after that. But first you need to analyze whether it's a lease or not. To evaluate lease, whether I have a right on that particular asset, where I am using significant outputs. Second, whether all these, or there is a fixed pay or not. So all these criteria is there. There is an asset. First you have to identify there is an asset. There is a plant. Yes, there is a plant. whether that plant, I control that plant particular. Control means I have physical control, or I have business control over that plant, or I am paying any fixed pay on that. Even though he is not supplying me anything, I am paying them the fixed. So all those criteria after evaluation you conclude it as a lease. After lease, it's a finance lease or operating lease. If it is an operating lease, no finance cost, you're smooth. If it is a finance lease, then you calculate the finance lease receivable, then again interest, then MLP, all those things you calculate and account for that. Whatever interest component in that finance lease will come, that will be classified as borrowing cost.
But it is the asset will not be sitting in our books, so we can't have any depreciation in our book regarding that asset on which we.
In IGAP, yes, we don't have depreciation. Today we have depreciation.
We'll have depreciation.
Yes.
But the asset is not sitting in our books.
In our books, no. Today, after concluding this particular asset as a finance lease, the asset will come in our books, no.
Even though we are not legal on it, we can't charge that asset. We can't raise any incumbrance with that asset.
So that's a different question altogether. Accounting you need to do in that manner. That's a different question, whether who's right, who's things, all those. But however, those are the critical criteria to evaluate whether it's a lease or not. It's a good question. Those are critical factors to evaluate whether it's a lease or not.
So what's the basic criteria to differentiate whether it is operating lease or finance?
Major contracts you evaluate whether the store terms are there or not, fixed pay are there or not, whether they are supplying solely to us or not. All those are the indicators when you evaluate particular contract. Any more questions on this? Ind AS 23? Any questions?
Interest?
Yes.
Interest on short-term borrowings related to non-specific borrowings can be capitalized.
This why it is not capitalized? Capitalized, it's a borrowing cost. It meets the definition of borrowing cost.
Because that short-term borrowings cannot be used for assets which is not like.
So that's a different, altogether different particular thing you are talking about. If I am using that particular borrowing in my capital assets, that is a standard requirement that you cannot use that particular thing. If I am using, standard does not prohibit you. If you have a borrowing cost, the short-term borrowings interest are borrowing cost. If you have a borrowing cost, if you have a qualifying asset, you capitalize it. The questions you are coming from earlier in Caro, that is there, that you cannot use short-term loans for long-term. So that not coincided in this standard. So these standards talks about borrowing cost and qualifying assets. If you have a qualifying asset, you have borrowing cost capitalized.
Is there any difference between qualifying asset as per Indian GAAP and India's?
Qualifying assets as per Indian GAAP.
Like earlier it was maybe for more than 1 year or so, it takes time to select. Is there any change in India's for qualifying asset period and something like that?
No, in period there is no change. It is substantial is there. 1 year no, in Indian GAAP also not written.
In
In
what period you say?
substantial normally we conclude as operating cycle. If my operating cycles I conclude as more than 12 months, then substantial I conclude if that is more than that operating cycle. So in Indian GAAP also that 12 months is not there. It is our mind frame. We always think that it is if more than 1 year, then it is substantial, but it is not way written. It's we are taking a guidance or something like that. In Indians there is nothing like that. If there is substantial period in construction or like that, then you can capitalize. Yes, there is a difference in the qualifying asset definition. That is investment property in Indian GAAP it is not there. In Indian GAAP it is building only. So here investment property if you are classifying something, then you can capitalize borrowing cost. Any questions?
Good question, but there can be one litigation regarding TDS in these cases.
Here so.
And we might consider it to be finance lease, we may consider it to be operating lease, and that conflict can arise.
That's a TDS on payment basis. So when you pay the minimum dues, you have to deduct. You are deducting on behalf of someone, government. You are an agent. You are not principal on that.
But if we say it is operating lease, then there is no question of any TDS.
No, TDS is nothing relating to this.
I understand.
So can we move to another standard? There is lot of time. You can ask questions if you have.
If we have taken a foreign currency loan for working capital, and at the end of the year we determine the MTM mark to market, and there is MTM loss, then shall we show it as a foreign exchange fluctuation loss, or shall we show it as a financial cost?
I'm not able to. Let me clarify your question. So you have a foreign currency loan
For working capital.
for working capital. Okay. So you taken derivative contracts, forward contracts for this, on which you have MTM.
That's right.
That's right. Correct. I got your question.
Yeah.
So this particular short-term loan means I will repay it before my operating cycles, that is 12 months.
Yeah.
So exchange fluctuation will come. Exchange fluctuation I will account for as per Ind AS 21, and this particular derivative contract is as per financial instruments, that is Ind AS 109. Ind AS 109 talks about if there is no hedging relationship established, if you already done a hedge accounting, hedge documentation, yes, this particular item you can take. There is two hedges, cash flow and fair value hedges. If you are doing cash flow hedges, then you will park it. If you are doing fair value hedges, then all the fair value changes will go to P&L, and P&L, then if you have foreign exchange losses, it will go there. So these are the simple thing. If you are not doing hedge accounting, simple, then mark to market loss, you gain mark to market loss. Ind AS and IGAAP difference is that earlier you cannot book mark to market gain. So you win under Ind AS, if there is mark to market gain also, you can book it.
And disclosure will be as borrowing cost, or it will be disclosure as foreign currency loss?
This derivative.
No, without derivatives.
So it's not borrowing, no, because it's a short-term loan, and you have not taken this particular loan for any capital assets. No. So it's not applying that.
Okay.
Application of Ind AS 23 and AS 16 is there, where you have a foreign currency loan used in capital asset, qualifying assets. Then it comes into picture. So in this case, it's a fluctuation.
Disclosure, it will be disclosed under finance cost. It will be disclosed as foreign currency loss,
It's a foreign exchange loss.
not as finance cost.
Because it's a year-end reset, no?
Yeah.
Foreign currency conversion. So it's a foreign exchange
It
loss.
will not go as finance cost.
Suppose if we hedge our liability for a capital asset, then we get there is a mark-to-market gain. Will it be adjusted against borrowing cost? We are
Will be
not
adjusted.
using hedge accounting. We are not doing hedge accounting. But there is a gain.
So there is lot of difficulties in these particular questions, but in simple, if you have all these items, no, if there is any forward contracts or IRS or anything where you are getting gain, and in the exchange translation you have loss, then earlier there is a institute recommendation on this particular issue. When FCMI TDA, this clause para 41 comes for this foreign exchange monetary item difference account. So at that particular time they told that this exchange this mark to market gain and loss you should take and net capitalize into the block. But in Ind AS it is nowhere talks about that, and Ind AS does not allow that. So
Even that was, I believe, temporary measure. Only to accounted companies entities for a short-term period.
but that temporary measure takes 6 years, so it is not temporary. From 2009 to 2016 we are still doing it.
It was temporary.
Yeah. Any more questions?
Can you take up some other short standard?
That and it is more expensive. next standard we are going to look at it is intangible assets. Again, why I am comparing always with our previous gap, so that it is easier for us to relate what we know, what the extra we know, so that we will be under Ind AS. So what will be our journey? If you look at Ind AS 38 and our AS, what is the intangible standards number? 26. So AS 26 and Ind AS 38, again there is no major differences. Yes, there are few differences, but there is no major differences. So I will take you through the Ind AS 101 standard also. What are the cost model, then revaluation model, all those, so that it will take longer time because you guys are not asking any questions. So I need to spend at least 1.5 hours. That's told to me. Earlier, when we saw goodwill in our financial statements, we talk about goodwill is an intangible asset, right?
Yes.
Yes. But this particular Ind AS 38 will not deal with goodwill which are arising out of business combination.
What can be any other part of goodwill other than business combination? Other than business combination, can there be any other item which can be classified as goodwill and which forms part of intangible assets?
Consolidation goodwill which is arising, that is a goodwill.
And that will form part of this.
But recognition will, this particular recognition measurement will not come. But when you go for impairment, they indicate impairment testing and all, definitely you can take the directives from here. This will not cover the measurement principles, but impairment principles of IS 38, that is read with IS 36, will follow for goodwill. That how you test for impairment of goodwill is the similar line with that.
Even though standalone units have got no such date and there will not be any preference.
Correct. So coming to financial assets, it's IS 39, it's not IS 39, it is IFRS 9, which is now in Ind AS 109. So mining rights and DA, this one is IFRS 6, which is equivalent to Ind AS 106, exploration, evaluation assets. Deferred acquisition cost, that is insurance contracts, which is very difficult standard.
So it is 109 or 119?
It is 109.
109.
109 means 109. 119, I am not talking about 119. 109, 109, 109, okay, 109. So, when for inventory standards it's not applicable. Deferred tax asset definitely Ind AS 12 is applicable. Deferred tax, there is a lot of differences again, so we are not covering that difficult standard.